Hi everyone, I'm here today in the Wealth Lounge welcoming Justin Oliver, CIO of Canaccord Genuity Funds. We've been working with Canaccord for a very long time. I have many of my clients in Canaccord funds, whether it be their pensions or their lump sums, or whether they're saving regularly. It's a firm that we really rely on, and they bring a lot of expertise and knowledge to the table. So I'm really happy to have Justin on board today to share his thoughts, share his insights, and just tell us a little bit about how Canaccord work. Justin, I'm not going to delay. I'm going to bring you straight into what's going on at the moment. There's lots happening. We're now about 4 or 5 weeks into the war, probably a little bit more with Russia. We're seeing stats coming through. How are things being processed at your end from the fund side?
Yeah, I mean, there's obviously a lot to think about, and actually a lot to talk about. I think, as you rightly highlight, front and center is the war in Ukraine, and actually probably that's the most difficult thing to talk about in a way, because it is front and center of the headlines, but actually how things will develop in terms of that sort of conflict and what the actual outcome is. It's very, very difficult to say, and in fact, I don't believe anyone can accurately predict the outcome as far as that is concerned. Obviously, in the meantime, we are trying to deal with the repercussions in terms of financial markets, and obviously, I think first and foremost to say, obviously, the humanitarian crisis in Ukraine is shocking to behold, and our thoughts and prayers are with everyone out there. But we're trying to obviously navigate our way through. We've got that, and obviously the impact on oil, and energy prices, potential diesel shortages, and that's all feeding through to rising inflation at a time when really we could have done without those extra bit of inflationary pressures, because they were looking quite robust to begin with, because we've still got those sort of supply chain bottlenecks. Again, we're seeing if we're moving away from Russia and Ukraine, obviously parts of China are still being locked down. We've seen that in Shanghai over the recent couple of days. So there's a lot going on, and then we've got the US Federal Reserve, who are obviously looking at the inflation picture, and the expectations for interest rate rises have been sort of further increased. Some very hawkish comments over the past couple of days. So not a quiet beginning to the quarter or to the year, if I can put it that way.
No, definitely. I mean, do you feel there's been a slight kind of not anymore, but a couple of days ago I'd have said there's been a slight uptick in sort of across the markets. It looked almost like people were getting used to the fact that this conflict's not going to go away and starting to get on with their lives. And do you think there's an element of that? And do you think that can continue? Whenever there is this kind of situation, not that we've had many conflicts of this kind of size, but where it just gets people acclimatized to it and start to move on, and we see a slight bounce back in the economy because it becomes an inherent part of day-to-day living.
Yeah, I mean, certainly, I think there's an element of that. You're absolutely right. But, I think if we're looking again at financial markets, outside of the initial bit of volatility we saw in equity markets, the biggest impact has been felt clearly in terms of bond markets. So government bonds, actually investment grade bonds in the US and UK have all been hit quite hard, because actually what matters for bonds and bond investors is the inflation and the interest rate backdrop, and both of those have deteriorated quite significantly. I think again, if we're looking, put fixed interest to one side, we're looking instead of equity markets. I think as far as we're concerned, markets have been a little bit more stable. Actually, that's probably about right, because I think while growth has softened a little bit, I think it's reasonable to expect, and again, on the expectation that the Russian-Ukraine situation doesn't deteriorate significantly further, you would expect growth to begin re-accelerating in the second half of this year. I think it's also fair to say that inflation is high at the moment, but again, all other things being equal, you would expect it to moderate as some of those dislocations from Ukraine and the pandemic subside. And similarly, while there's a bit of concern about the Fed and what they're going to do in terms of hiking interest rates, it is still going to be quite some time yet until interest rates are in that sort of restrictive territory. Yes, they're going up, but real interest rates were as low as they've ever been, and clearly that's not appropriate given the inflation backdrop at the moment. So
Yeah,
I think there are reasons to be optimistic, but sometimes when you're faced with so much negativity coming at you from the headlines, you've sometimes just got to take a step back, I think.
There's been, absolutely. There's been a huge there's crisis going on in the Western world. I mean, it's primarily in places like UK and US where people are just struggling with the cost of living now. Energy prices have surged. There's now a lot of discussion around reducing dependency on Russia. And how well do you think that they're talking big about it? Germany and Europe are talking about it a lot. And how effective do you think that can be? How do you think it'll be something that could be done as per their forecast, which they say it's going to take about a year? Or do you think, did that come with a lot of baggage, and do you see these issues dragging on? I personally don't think it's as easy as they're making it out to be. And I think that will still put a lot of pressure on the prices, and we're not going to see an immediate solution in place. But yeah, what's your thoughts on that?
Yeah, no, I broadly agree with your view there. I think the direction of travel is certainly it's in one way, and again, in a way, it was moving away from that dependence on oil generally, even before the Russian-Ukraine situation started, and all that's really done is kind of hasten the move that was going to happen anyway. Again, anything to do with energy and commodity markets are always a little bit opaque, at the best of times. I think from our reading of the situation, we probably share your skepticism in terms of Germany being able to weed itself off of Russian oil in a year. I think is somewhat over optimistic. But again, we have seen obviously moves in terms of the US reducing or making oil available from their strategic petroleum reserve. And again, I think that will also happen. There'll be further supply coming on from some of the shale producers, potentially, given where oil is at the moment. But again, that all takes time. So we shall see as far as that's concerned.
So for the foreseeable future, we're not going to see our heating bills dropping anytime.
Thankfully, in this hemisphere, we're moving into summer, so I won't have to worry about heating until probably October. But hopefully, oil's down a bit further from where it is at the moment.
And just briefly on China, obviously such a powerhouse, but they're back into sort of lockdown, and their economic output has dropped a little bit recently off the back of that. How do you see that playing out for? I mean, it's hard to say because they're being incredibly cautious. But what sort of impact do you see that happening? That putting on the rest of the global economy?
Yeah, I mean, obviously China's got quite a few things to contend with at the moment. Obviously, their zero tolerance approach to COVID is making economically life very difficult. At the same time that they're also trying to manage the fallout from the Evergrande situation and the excesses in their property sector. They're almost trying to have a controlled implosion of the property sector, but not derailing growth too much. When we know that China's economy has been in the past very dependent on the property sector, and any growth which has come through has typically come through the property sector, and it's typically exacerbated some of those excesses. So Chinese policymakers have got a very, very difficult balancing act. But what they do have at their disposal, of course, is the ability to add further stimulus to the economy. And I think that's potentially what we'll see moving forward. And let's not forget, 2022 is a very important year as far as China is concerned. They've got an objective to achieve GDP growth of, I think, 5.5%. So they will achieve that, as we know, by hook or by crook. But I think it will require a lot more stimulus being applied to the economy. And they've got a few other policy goals that they're trying to implement. That sort of return to common prosperity, that crackdown on the tech sector, which we saw recently, etc. Again, all sort of issues that we need to keep an eye on. But actually, I think valuations in certain parts of China do reflect reality, and I think actually there might be some attractive investment opportunities there. Maybe not quite yet, but again, sometimes you want to be buying when when the news is bleak, and arguably there's not a lot of good news coming out of China at the moment, which does mean that some of the valuations perhaps are attractive.
Yeah. And in terms of your own Canaccord's own kind of managed strategies, where are you focusing on in terms of your kind of areas geographically, your assets? What are you positive about at the moment?
Sure. Well, we'll go through the main asset classes. I mean, thankfully, we've been underweight bond markets for quite a considerable amount of time, and then where we have got fixed interest, it's typically been the inflation protected variety. So, I'm not saying we made masses from that sort of allocation, but again, it's holding up reasonably well. As far as equities are concerned, again, we're trying to take a step back and so ignoring, in a way, a lot of the noise that's coming through. Do we still think that the next 12 to 18 months will be a positive environment for equity markets, for risk markets? Yes, we do. So we're still overweight equities, reflecting the slightly more cautious environment, and I think the economic impact on Europe of the Russian-Ukraine situation. We have taken some money out of Europe and rotated it just towards the US. Obviously, valuations there are looking a little bit more attractive. We've also put some money into banks, which we did earlier on in the year, just an expectation that the yield curve, once things return to normal, will begin to steepen again. And actually, that's quite a good environment for banks, which are also offering, I think, value over the long term. Not quite as exciting as we know as technology, etc. But sometimes those sort of value areas have been very much in vogue. And I think our recommendation would be maybe sort of a barbell approach. Balancing value on the one hand, so be it sort of banks, actually be it the FTSE 100, in the UK, with some of those more exciting thematic opportunities. I think will be the way to go moving forward.
Yeah, and do you think the tech sector has corrected to the right levels, or do you see it as still something that's going to be volatile?
Yeah, I think it's still going to be volatile. I think there are pockets of value, but I think some of those more speculative areas, perhaps exemplified by Cathie Wood's ARC, I think perhaps we'll see further volatility. So probably stay away from those more speculative areas at this moment in time. But again, if you're looking at some of the large the mega caps, if you're looking at Microsoft and the Amazons and the Apples of this world, they're still generating significant amounts of free cash flow, which I think in this sort of environment is what you're after.
Yeah, and they're relevant, I guess. They have their fingers in lots of pies that all have a role in our lives. So I guess we can't really run away from them. We've got to work with them.
Yes, right.
Brilliant. Well, I'll wrap it up there. But thanks so much for coming on, Justin. We'd love to have you back again. But that's been really useful. And thank you, and goodbye for now.
Thank you very much indeed for your time. I'm really delighted to be back at some stage.
Thanks very much, Justin. I'll just
thank you.